Are you truly prepared for your financial future? We'll discuss the advantages and disadvantages and how some people have used them to their advantage, so watch till the end. In the world of investing, every decision has its weight in gold, or in this case, in potential retirement comfort. Financial security isn't just a goal, it's a necessity. The choices made today can forge the path for a stable or shaky future. That's why understanding the landscape of investment opportunities like SCHG and DGRO is not just beneficial, it's crucial. Let's dive deep into SCHG versus DGRO and how you could use them to your advantage at the end. What exactly are SCHG and DGRO? Here's what you need to know. SCHG, or Schwab U.S. Large Cap Growth ETF, is a fund that targets high-growth potential companies in the U.S. market. With its low expense ratio of 0.04% and a modest dividend yield of 0.4%, SCHG is designed for investors looking to grow their portfolio to a critical mass. It's a thrilling ride, with its best year seeing a 50.11% increase, though it does come with the risk of significant drops, as seen in its worst year with a negative 31.8%. On the other hand, DGRO, the iShares Core Dividend Growth ETF, focuses more on providing investors with steady dividend income. It has a higher expense ratio of 0.08%, but offers a robust dividend yield of 7.72%. This fund aims for stability and growth through dividends, making it appealing for those seeking a reliable income stream. With these profiles in mind, let's compare SCHG versus DGRO on critical financial metrics. Now let's get down to the brass tacks, expense ratio and dividend yield. When comparing SCHG versus DGRO, it's essential to consider how much each fund charges and what it pays back to its investors. SCHG, or the Schwab U.S. Large Cap Growth ETF, boasts a remarkably low expense ratio of 0.04%. This means for every $1,000 invested, only 40 cents go towards fund management fees annually. Conversely, DGRO, the iShares Core Dividend Growth ETF, has a slightly higher expense ratio of 0.08%. This translates to 80 cents per $1,000 invested. While this difference might seem minimal, over the long haul, these fees can significantly impact total investment returns. Now let's talk dividends. DGRO shines with a robust dividend yield of 7.72%, which is a considerable return directly to the investors. In contrast, SCHG provides a modest dividend yield of 0.4%. This stark difference illustrates DGRO's focus on generating income for its shareholders. Lower expense ratios and higher dividend yields can be attractive, but they're only part of the story. Next up, let's look at returns. You invest to grow your wealth. So how do SCHG and DGRO stack up in terms of returns? Let's dive into the numbers. SCHG, the Schwab U.S. Large Cap Growth ETF, boasts an annualized return or compound annual growth rate of 15.68%. It's quite the performer, especially in its best year, soaring to an incredible 50.11%. However, it wasn't always smooth sailing. The worst year saw a sharp decline of 31.80%, mirroring its maximum drawdown. On the other side, we have DGRO, the iShares Core Dividend Growth ETF. It presents a more modest annualized return of 11.17%. Its peak performance in the best year was 29.88%, with the lowest dip at -7.90% during its toughest year. The maximum drawdown here was less severe, at 21.92%. These figures highlight the stark differences in how SCHG and DGRO perform under various market conditions. Impressive numbers, but let's delve deeper into risk and rewards with SCHG versus DGRO. Every investment carries risk, but how much risk are you really taking with SCHG and DGRO? When diving into the world of investments, understanding the volatility and potential for returns is crucial. Let's start by looking at the standard deviation of both ETFs. SCHG has a standard deviation of 17.92%, indicating higher volatility compared to DGRO's 14.58%. This suggests that SCHG experiences wider swings in its value, which could mean higher gains or greater losses. Now, let's talk about the Sharpe ratio, which measures the performance of an investment compared to a risk-free asset after adjusting for its risk. SCHG stands at 0.82, while DGRO is at 0.69. A higher Sharpe ratio indicates better risk-adjusted returns. Thus, SCHG holds a slight edge here. Moving on to the Sortino ratio, which focuses only on the downside risk, SCHG again leads with 1.33 against DGRO's 1.10. This ratio tells us that SCHG provides a better return on the negative volatility. Understanding risk and reward helps in making a balanced investment decision. Let's summarize our findings. To secure your financial future, choosing the right ETF is crucial. We've traversed the landscape of SCHG versus DGRO, dissecting their expense ratios, dividend yields, and annualized returns. SCHG dazzles with a low expense ratio of 0.04% and a compelling annualized return of 15.68%, making it a beacon for growth-oriented investors. Meanwhile, some people have used both funds to their advantage. Here's how. In the early stages, focusing on SCHG to gain a critical mass of portfolio value over 20 to 25 years so you can outlast any potential recessions. Then swap an amount over to DGRO when you want to replace your income with DGRO's 7.72% dividend yield. That percentage functions on the total amount of capital DGRO. That's why you focus on SCHG to grow the portfolio as big as possible before then. With dividend funds, they tend to fall behind in terms of capital appreciation, so only receiving the dividends that you need with whatever margin of safety might be important to you. Like all things investing, it's not a one-and-done event. You must likely have to dollar cost average to snowball enough to replace your income if that's what you're looking for. Remember, there are a lot of personal factors in your life could make any plan a good one or a bad one, so talking with a financial professional would probably be wise for you. We also peeled back the layers of risk associated with each fund. SCHG, with its higher standard deviation and maximum drawdown, suggests greater volatility, but also the potential for higher rewards. On the other hand, DGRO's lower risk metrics indicate a more stable but perhaps less meteoric growth trajectory. As you align your investment choices with your personal financial goals, consider how these factors, costs, potential returns, and risk levels, play into your long-term financial health. Remember, in the world of investing, knowledge is not just power, it's profit. SCHG versus DGRO. Which fits your financial narrative better?